Hello friends, welcome to Learn Easy. We will discuss valuation ratios in financial analysis. Valuation ratios are an important part of financial ratio analysis as they allow us to assess the value of a stock by comparing metrics like share price, earnings, sales, cash flows and dividends. When you go for investment in stock market, valuation ratios help us to assess whether a company's stock is fairly priced, overvalued or undervalued in the market. Valuation ratios can help us in identifying attractive investment opportunities and avoiding overpriced stocks. These ratios are helpful to us in creating a long-term investment portfolio by identifying stocks that can help us in wealth creation in the long run. Valuation ratios play a very important role in financial ratio analysis. Importance of valuation ratios are: first, we can find out the best investment opportunities by comparing different stocks with the help of valuation ratios. Second, a company with strong valuation ratios is more likely to attract our investors looking for profitable opportunities. One request: if you are new to my channel, please subscribe, share and press the notification bell. Third, these ratios help to identify overvalued and undervalued stocks and compare different stocks in the same sector to determine better valued stocks. Fourth, valuation ratios are useful in both growth investing and value investing strategies. Our value investors look for low P by E and P by P ratios, while our growth investors focus on the price to sell P by S and PEG ratios. Fifth, valuation ratios become most helpful for companies to evaluate potential mergers, acquisitions or partnerships. The most common valuation ratios are for comparing a company's share price to earnings, cash flow, sales, book value and other financial metrics to assess relative valuation and growth potential of a company. Popular types of valuation ratios are: first, price to earning ratio, P by E. Second, price to book value ratio, P by BV. Third, price to sales ratio, P by S. Fourth, price to cash flow ratio, P by CF. Fifth, EV to EBITDA ratio. Sixth, dividend ratio. Seventh, price by earnings to growth PEG ratio. Now, first, price to earning P by E ratio. The price to earning ratio, P by E ratio, is a valuation measure used to compare a company's current share price to its per share earnings. When this ratio is high, it indicates that the stock price of a company is higher compared to the earnings and hence it is overvalued. On the other hand, if the ratio is low, it denotes the stock price is lower for the earnings and hence the company and its stocks are undervalued. So, price to earning P by E ratio is equal to share price divided by earnings per share. For example, let a company's stock is trading at rupees 150 per share and its earning per share for the last 12 months was rupees 25. So, P by E ratio is equal to rupees 150 divided by rupees 25 is equal to 6. Second, price to book value ratio, P by BV. The price to book value ratio, P by BV ratio, is the relationship between the market price of a stock and the book value of a firm's equity. Book value is derived by deducting liabilities from assets. A lower P by BV ratio could mean the stock is undervalued, while a higher P by BV ratio means overvaluation. Comparing P by BV ratio, we can identify whether stocks are trading at a discount or premium to book value. So, price to book value P by BV ratio is equal to market capitalization divided by book value. For example, suppose a company has a market cap of rupees 2 billion and its book value is rupees 1 billion. So, P by BV ratio is equal to rupees 2 billion divided by rupees 1 billion is equal to 2. The P by BV ratio is useful for capital intensive industries where assets are a major factor. Third, price to sales P by S ratio. The price to sales ratio P by S ratio is a valuation metric that compares a company's market capitalization to its total sales or revenue. By examining P by S ratio, we can understand where we should invest and where we must not. One request, if you are new to my channel, please subscribe, share and press the notification bell. A higher P by S ratio indicates a stock is overvalued relative to its revenue, while a lower ratio indicates potential undervaluation. So, price to sales P by S ratio is equal to market capitalization divided by total revenue. For example, suppose a company has a market capitalization of rupees 10 billion and rupees 4 billion in annual revenue. So, P by S ratio is equal to rupees 10 billion divided by rupees 4 billion is equal to 2.5. Fourth, price to cash flow ratio P by CF. Price to cash flow ratio P by CF ratio compares the share price of a stock to the cash flow per share. A higher P by CF ratio indicates that a stock is trading at a premium to its cash flow generation. A lower ratio indicates the stock is undervalued relative to cash flow. So, price to cash flow P by CF ratio is equal to market capitalization divided by operating cash flow. For example, suppose a company has a market capitalization of 4 billion and rupees 800 million in cash flow from operations. So, P by CF ratio is equal to rupees 4 billion divided by rupees 800 million is equal to 5. As cash flow fluctuates significantly, we should view the P by CF ratio over a multi-year period rather than a single year. Also, P by CF ratio should be used together with other metrics to determine if a stock is fairly valued relative to its cash flows. Fifth, EV to EBITDA. The EV to EBITDA ratio means the ratio of enterprise value to earnings before interest, taxes, depreciation and amortization. A lower EV to EBITDA ratio indicates the company is undervalued. Comparing the ratio to industry peers, we can understand whether the stock is relatively undervalued or overvalued stocks. Enterprise value EV is equal to market capitalization plus debt plus minority interest plus preferred shares minus total cash and cash equivalents, where market capitalization, that is equity value, is equal to current share price into total shares outstanding. Minority interest is the portion of subsidiaries not fully owned but consolidated into the main company's financial statement. EBITDA measures a company's operational profitability. The EV to EBITDA ratio helps us to compare the value across companies with different capital structures. For example, suppose a company has an EV of rupees 800 million and EBITDA of rupees 200 million. EV to EBITDA ratio is equal to rupees 800 million divided by rupees 200 million is equal to 4. Sixth, dividend ratio. The dividend ratio focuses explicitly on the dividend earned on every share bought by the shareholders. It is an important ratio for our income-focused investors. Low dividend ratio indicates the company reinvests profit for growth. Dividend ratio is equal to annual dividend per share divided by market price per share. When we select stocks for passive income, we often look at this ratio for selecting stocks. If this ratio is above 1, it indicates the company is paying its shareholders more than its net income. Seventh, price per earning to growth, PEG ratio. The PEG ratio or price by earning to growth ratio is a valuation metric that helps us to understand whether a stock's price is reasonable when its future growth is taken into account. A lower PEG ratio indicates a stock is undervalued given its growth rate, while a higher PEG ratio suggests potential overvaluation. PEG ratio is equal to P by E ratio divided by projected earnings growth rate. The PEG ratio provides us a more complete picture of valuation than just the P by E ratio. PEG ratio shows whether the P by E is justified by higher expected growth. Comparing PEG ratio, we can find out the stocks with reasonable valuations for their growth potential. Now, let us conclude. Valuation ratios are an integral part of the fundamental analysis of a company and are powerful tools that help us to understand whether its stock is fairly priced, undervalued, or overvalued. We use these ratios to evaluate the fair value of a company's stock price relative to its financial performance. That's all. Thank you for watching the video.